In July 2021, PayPal was worth $360 billion. Today, its market cap has slipped to around $40 billion, below even eBay, the company that originally spun PayPal off. From its all-time high of $310 per share, the stock has fallen over 80%. Today, it trades around $45. This is one of the most dramatic falls from grace in the history of fintech. Today, we break down exactly what happened, what the company looks like right now, and both sides of the story. The 80% collapse didn't happen overnight. It was the accumulation of 5 problems hitting at the same time. First, the pandemic hangover. PayPal was one of the biggest winners of the COVID era. People couldn't shop in stores, so everyone went online and everyone used PayPal. The stock priced in years of growth that arrived all at once. When the world reopened, that growth simply stopped. Second, the eBay divorce. For years, PayPal processed a huge volume of payments for its former parent company, eBay. But between 2018 and 2023, eBay replaced PayPal with its Dutch competitor Adyen as its preferred payments platform. Losing that volume hurt both revenues and growth rates. Third, competition exploded. Apple Pay, Google Pay, Stripe, Block, and a wave of buy now, pay later players all arrived with serious products and serious backing. PayPal's growing dependence on Venmo and Braintree, units that generate lower margins than its core platform, continued to erode profitability over time. Fourth, execution failures. Late 2025 and early 2026 earnings reports missed expectations on revenue and profit and painted a tepid outlook. Fourth quarter revenue of $8.68 billion and adjusted earnings per share of $1.23 disappointed analysts, reflecting softer demand and execution challenges. The word that kept coming up, branded checkout, PayPal's core product, was losing ground. Fifth, a CEO change. In February 2026, PayPal's board replaced CEO Alex Chriss with Enrique Lores, who came from HP, not a payments background. Leadership instability never helps a stock that is already under pressure. So what does PayPal actually look like today as a business? The fundamentals are not as bad as the stock price suggests. In full year 2025, PayPal grew total payment volume to $1.79 trillion, grew active accounts to 439 million, and grew net revenues to $33.2 billion. Adjusted free cash flow came in at $6.4 billion. This is not a broken company. It is a slowing company. The new CEO is moving fast. In April 2026, PayPal announced a strategic reorganization into 3 simplified business units: Checkout Solutions and PayPal, Consumer Financial Services, and Venmo, and Payment Services and Crypto. And there are new growth bets being placed. PayPal recently expanded its PYUSD stablecoin to 70 countries, making a significant push into crypto payments. The company is also cutting costs aggressively and buying back its own stock, returning over $6 billion to shareholders through buybacks in 2025 alone. The bull case starts with scale. PayPal owns approximately 50% of the global market share in personal payment processing. Half the world's online payments flow through PayPal's infrastructure. That kind of embedded position does not disappear overnight. PayPal has achieved a level of trust that is very hard for others to replicate, especially when money and personal transactions are involved. Users still prefer PayPal over competitors like Apple Pay, in part because PayPal stands between buyer and seller to ensure any problematic transactions are resolved. The valuation is the most compelling argument of all. At $45 per share, PayPal trades at roughly 7 times earnings, cheaper than almost any technology company in the S&P 500 and generating $6 billion in free cash flow annually. The company is cutting costs and buying back stock aggressively. Every share repurchased at these levels is mathematically accretive if the business stabilizes, and the new CEO has a track record. Enrique Lores turned HP around. His compensation is heavily performance-weighted, with the majority tied to stock price milestones, meaning he only gets paid well if shareholders do too. The bear case is equally simple. PayPal may be in permanent, structural decline, and cheap can always get cheaper. The branded checkout problem is real and persistent. Every quarter, a larger share of online merchants are routing payments through Stripe, Shopify payments, or native wallet solutions. PayPal's checkout button, once the default across the internet, is no longer automatically the first choice. PayPal is also currently dealing with a $30 million DOJ settlement, adding legal uncertainty on top of operational challenges, and the new CEO brings uncertainty of his own. Enrique Lores spent his career in hardware and enterprise technology, not payments or consumer finance. The board's appointment followed a detailed evaluation of the company's position relative to its competition, which suggests the situation was considered serious enough to require outside leadership. Turnarounds under new management take time, often more time than investors expect. PayPal at $45 is a very different company from PayPal at $310. The pandemic tailwinds are gone. The competition is fierce. And 3 CEOs in 4 years is not a sign of organizational health, but it is also a $33 billion revenue business, generating $6 billion in free cash flow with 500 million active users and a brand recognized in nearly every country on the planet, trading at valuations normally reserved for dying industries. Whether that combination makes it a bargain or a trap depends on one question nobody can answer yet. Can the new leadership stop the checkout market share erosion before the competition makes it permanent? That answer will define whether PayPal's next chapter looks like a comeback or a slow fade. Hit like if this helped, and subscribe for more deep dives like this one.